This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to look now at accounting for financial assets. These are things on the debit side of the balance sheet. Remember, they are primarily investments in shares and also loans made to other companies, or maybe it's a receivable from another company. So when we deal with financial assets, the first issue is how do we measure them initially? And so in terms of initial measurement, generally speaking, initial measurement is at the price paid. Now, the official rule is fair value plus transaction costs. Fair value would normally be the price paid, unless, for example, you were making something like an interest-free loan to someone, in which case, in practice, they might need to discount it, but generally it's the price paid, plus any transaction costs, although sometimes transaction costs are expensed. And you can see there's an exception. The exception is just listed across there. We're going to see this in some numbers questions in a minute, unless you choose to treat the investment as fair value through profit or loss. That sounds like a very complicated phrase. It's much simpler than it sounds. Particularly with shares, you can treat them, measure them at fair value and put gains or losses in P&L, in which case transaction costs like broker's commission, local taxes or something like that are expensed in the P&L. But our starting point is always to say price paid plus any transaction costs, at least usually. That's what happens at time naught. What happens later depends on the nature, again, of the financial asset. And we're focusing here on two financial assets, equity and debt. In other words, I'm actually investing in shares of another company, or I'm lending money. Always try and translate these things back into regular language. I'm either investing in shares or lending money. If you invest in shares, usually it's probably for the long term, but you might have a short-term interest. There's an element of flexibility. But if you invest in shares, notice that that investment must be carried at fair value. That is not a choice, so you must measure that investment at fair value, not at cost. After that, there is a sort of choice. The default is that gains and losses would go to profit and loss. However, if you've actually got a long-term investment, you would not be keen on that because, the stock market, gains and losses, the share price would be all over the place. Your profit and loss would be all over the place. And this is supposed to be a long-term investment. So if you want to, you can elect and say that your gains and losses will not go in profit and loss, in which case they go through reserves. So the default is profit and loss, but if the company intends to hold the shares for the long term, they can elect to have them dealt with through OCI. You'll see this word here, an irrevocable election. So when you did group accounts, you made an election about using full goodwill or partial goodwill. This is another election. So you either elect to put gains and losses in OCI, even on sale of the asset, or you don't, and if you don't, gains and losses will go to profit and loss. How will you know if they've made the election? Again, it will say in the question. So we'll see an example of that in just a minute or two. So investing in shares, you must measure at fair value. Normally gains and losses go to P&L, but there's an option to put them all through OCI in respect of a particular investment. And you could make different decisions for different investments, deciding on whether the investment was for the short term or the long term. If you go the second route, all gains, all losses go into OCI. Doesn't matter if it's a profit or a loss, it goes to OCI. With PPE, you can't have negative revaluation reserves. With this, in fact, you can, because the assumption, I think, is the share price will at some stage recover. Usually. So that's what we do with shares. When we lend money, well, you could use fair value, but that is very rare. Normally, when you lend money, you will use cost accounting. And you will have met amortized cost accounting in financial reporting, both when you first met financial instruments and also in lease accounting. You've probably met it there. It simply means use the cost model, compare money in and money out. Initially, I give them some money. They give me some money back every year and a big lump sum at the end, and it goes through the profit and loss using cost accounting. That is on the assumption that it is a genuine loan and that you're not something like a bond dealer. So as it says here, the normal method is amortized cost. The test that's really relevant in the exam is this one. If you simply lend the money, intend to wait with the loan until it's repaid, then it's amortized cost. It may be that you're something like a bond dealer, so you buy and sell these bonds all the time, in which case the fair value would be more relevant. That's particularly an issue with things like gilts or treasuries. You might want to hold a treasury or gilt for a specific period of time and then sell it on. Bond prices are linked to prevailing interest rates. You learnt that in financial management. So if you're planning to sell it on, then actually fair value would be the normal accounting. So as it says here, if you don't intend to hold the asset to maturity, you can measure it at fair value. Gains and losses would then go normally to OCI. But for the sake of the exam, the key thing is that this is the normal position. This one down here is rare, unless you are Barry or Brianna, the bond dealer. So this one here is a much rarer situation. We will look at some numbers around this in a bit. So initially, shares, always fair value, gains and losses, either P&L or OCI. Debt instruments, normally the cost model, so don't worry about fair value unless you actually trade these debt instruments on. Final recap up at the top, we said that in terms of the transaction costs, normally capitalised unless you hold the investment at fair value through profit and loss. Now, that's the position again in terms of measurement until you come to sell the financial asset. Then, so derecognition up here is what happens if you come to sell the asset. So this is sale of the financial asset. When you come to sell it, well, generally speaking, you've always been happy, I expect, that if you have something in the books at 8 and you sell it for 20, there's a profit of 12. Normally goes to the profit and loss, doesn't it? whether it's a sheep or a potato, well, that's the starting point. There are one or two odd things around this. We're going to practice this in a scenario question in a minute, so be calm. But at some stage, these rules will have to get learned. If you've got shares and you hold them at fair value through profit and loss, gain or loss in P&L. If you've got shares and you've made an irrevocable election to actually put the gains or losses into OCI, then gain or loss goes into OCI, apart from the transaction cost. We'll see an example of that in just a minute. If you've got debt, so this is where you are a bond dealer, you hold the debt investments, again, gains or losses go to OCI. And for the moment, don't get very excited, but only with debt. We met the term recycling when we talked about disposal of a foreign sub, that gains and losses earlier recognised in OCI are then recycled to P&L. You get a very similar adjustment here, but do bear in mind, from an exam and life perspective, that one is very rare. The main message, the main thing to appreciate is that if something is designated fair value through P&L, gain or loss on disposal will end up in the P&L. If something's designated fair value through OCI, well, the principal gain or loss will end up in OCI. So there we go. There are the derecognition. Just so you're clear that, Rule 1 there is about equities, fair value through profit and loss. Rule 2, equities at fair value OCI. Rule 3, which is the one that looks really strange, is debt at fair value through OCI. But you can even pause the recording now, phone up your uncle or something and say, "Uncle, let me tell you the story." Well, equities, fair value, P&L or OCI, debt, cost model, unless you are a bond dealer, in which case, fair value through OCI. So if you've got that far so far, then we're cooking with gas. So we're going to take a look now at an example called Norman. We will look at each of these scenarios individually. So before you actually listen to the next part, just look at the very first scenario. So we'll treat these as complete separate questions as we look at Norman and his problems. So pause, have a look at the first one, and then we'll talk. Pause, have a look at the second one, and then we'll talk, and so on. And above all, be calm before you carry on. In the first scenario, we can see it is an investment in shares. It does not say that they have made an irrevocable election for OCI. It will say that in the exam. So my assumption, the default position, is that these shares will be measured at fair value. Gains and losses will go to profit and loss. Some people abbreviate that to FVPL. Some people FVTPL through profit and loss. It doesn't matter. Fair value, gains and losses to profit and loss. And we said right at the start that if you designate an investment in that way, any transaction costs must be expensed. So this fee of 25 cents paid to the broker, again, that fee will be expensed in the profit and loss right at the start. We're going to look at this transaction on two dates. First of all, the 1st of November. So initially the 1st of November. And then secondly, a couple of months later on the 31st of December. So Norman, This is scenario 1. I'll number these. First scenario. First thing is the 15th of November. We've said again that these investments are to be classified as fair value through profit and loss. I will explain it using journals, but as always, you don't need to do journals. You can say up or down. You get the same answer. Obviously, it's absolutely fine. So because those transaction costs are expensed, we're definitely going to have a financial asset coming in the SOFP. We're also going to have an expense in the P&L. That's the transaction costs. And we're also going to have a movement on cash. I'll do this in single dollars. So financial asset goes up, item of expense, and cash goes down. Let's look back at the scenario, being careful about our units. It's 100,000 and each one costs $5. So 100,000 again at $5. Even I can do that. So 100,000 times $5 would give me a financial asset of 500,000. Profit and loss will be the transaction costs. Well, it's 100,000 shares. The transaction costs on each of those shares is 25 cents. So 100,000 times 25 would be 25,000. Cash, of course, is the other side, 525,000. At the year end, at the 31st of December, we're going to have to revalue them. So it looks to me, let's have a look for a moment. The share price was a $5. Oh dear, oh dear, oh dear. It's gone down to $3.50. Life's a sausage. The financial asset is going down. Profit is going down as well. So I'm going to have a debit to profit and loss. Or let me just put the arrows in for the other bit. Financial asset goes up, profit goes down, cash goes down. I'm going to have a debit to profit and loss. I'm going to have a credit to financial asset. So the financial asset is going to go down as well. Let's just compare. The old carrying value upstairs was 500,000. The new carrying value down here, 100,000 shares at $3.50. So the new carrying amount is 350,000. So that's a loss, isn't it, of the P&L of 150,000. How sad. I'm certainly glad it's not my money. And I'm sure you're glad as well that it's not any of ours money. There's the first scenario. Again, if you want, pause the recording, read the second scenario, play with the numbers, and then we'll talk again. Notice in what I did my first debrief, as subheadings, I was using the dates, just so it's clear what happened on each date. So there's a long-term strategy, again, So the examiner will actually be clearer than this, but these investment, I think, these shares, and they are shares again, would again be measured at fair value. Because they're a long-term investment, gains or losses will go to OCI, all of the gains or losses. Can you see that this time we've got 3 dates to be excited about? The 1st of March, the 31st of December, and finally the 31st of Jan when the shares are sold. If there had been, oh yes, there are some transaction costs, so because they have fair value through OCI, not P&L, those transaction costs will be capitalised, will be added to the cost of the asset. So the first thing that happens then, in that second scenario, just numbering these 1, 2 and 3, is that is the 1st of March you buy the shares. So here we are. I'm on the 1st of March. It's a long-term investment, so my assumption is they've made an irrevocable election to measure them at fair value with gains to OCI. So there's going to be a financial asset and a reduction in cash. The financial asset goes up, cash goes down, and we capitalise the transaction costs. In the scenario, I'm just changing my highlight now to yellow. The cost of the shares was 500,000 and transaction costs, that says incurring, not including, so be careful, was another 40,000. So it cost me 540,000. So the financial asset is going up by, again I'll use single dollars, is going up by 500,000 plus 40,000. That's an increase of 540,000. Cash is the other side of the entry, and we would explain that these transaction costs now are being capitalised. So there we are. I'm just writing against that, capitalise the transaction costs. Capitalise means add them to the value of the asset. The next thing that happens is on the 31st of December, when these assets are revalued. So when they are revalued, the financial asset will change and the other side will go into OCI. Let's have a look what's happened here. So I mustn't get too emotionally involved. The price has gone up to 620,000. So that is an increase, isn't it? And again, it's a gain in OCI. The new carrying amount is therefore 620. So there's a gain. It's the difference between 620,000 and the old carrying amount, which was 540,000. It's a gain. That will increase the financial asset. The credit will go in OCI. The difference between the two is 80,000. It's a gain. So both the asset and OCI will go up. Finally, in this example, we sell the shares and we sell them, there's another gain, isn't there, for 650. So finally, on the, what's the dates now? The 31st of January. On the 31st of January, we come to sell the shares. When you sell the shares, I can see it's a gain, so I'll be debiting cash. The proceeds we just mentioned were wonderful, 650,000. That's on the positive. We're going to say goodbye to the financial asset. Bye-bye. The financial asset, remember, is now in the books at 620,000. Your election is irrevocable. So any gain is going into OCI. 30,000, 650 minus 620. The financial asset, the cash is going up, the asset's going down, OCI is going up. If there had been transaction costs, so if you'd had broker's commission or something, that cost would be separately accounted for in P&L. There aren't any. And bear in mind that I mentioned this recycling term. The recycling term only arises in very rare situations if you're selling a debt asset. That's not the case here, is it? So looking back up here, equities, then all you do is put the gain or loss on disposal to OCI and nothing else happens. And there we are. That's Norman and their second lot of shares. Again, pause the recording if you like. Have a read of the third one, which you have met before when you did financial reporting, and then I'll go through it when you've had a little go at it. When you learned to do amortized cost, because these are debenture, it's just another word for a loan, isn't it? When you learned to do amortized cost, I think you probably learned it with a 4-column standard working. That's what I'd recommend as we try to work out, again, how much should be in the profit and loss in respect of this. I'm not a bond trader, I'm just an ordinary person, so I use the cost model. So therefore, this is accounted for using amortized cost. In which case, I would use a standard 4-column working. What I'm trying to do is to reconcile the carrying value in the balance sheet from the start of the year to the end of the year. So when we get to this third transaction, this is the debenture, which is being measured at amortized cost. Standard working is that you take the value brought down at the start of the year. That would be the figure that you would have found in the opening SOFP. You then add on any finance income. This looks like a multicolored debrief at the moment, but never mind. That's the figure that will go into the P&L. You then deduct any cash received from the lender. That's the figure that would go in the cash flow. And finally, right at the end, you get to the carried down figure, which would be the figure in the closing balance sheet. And we're just looking at this instrument in the first year. And we're looking at it very calmly. So the question, therefore, is what figure do you put in at the start? So we have to be very careful with the language here. I bought 10,000 of these. We don't like the word debenture, do we? So just substitute the word sausage. I bought 10,000 sausage. Normally a sausage costs 100, but I got a 2% discount. Be an expensive sausage. But if the regular price of sausage is 100, I get a 2% discount. I'm buying them for $98 or £98. So be careful with your units there. So initially, again, what's happening is that I will capitalize that financial instrument at the amount paid. The amount paid is, what did I say? Be careful with your units. 10,000 times, well, you could say 98% of 100, but I think we've got the message. It's 98. That's because you got this 2% discount. So count your units very carefully. 98 times 10 would give me an opening carrying value of 980,000. You will be given the effective rate. The effective rate of interest is the figure that actually goes in the P&L. There it is. I'm highlighting it in yellow. That's the P&L rate, which is 5.71%. That's applied to the current carrying value. So just like lease accounting, 5.71%. 5.71% of 980,000 is 55,958. Every year, the borrower has agreed to pay me a fixed sum, which is sometimes known as the coupon. It's just a name. The coupon rate is always on the nominal value of the shares. So the coupon rate, you can see here, just highlighting it in green, the coupon rate is 4%. That 4% is always on the par value. It's just the way that these agreements are drawn up. So if you're trying to work out the coupon, which will be the same every year, which is the money that they give us, that's going to be 10,000 times $100 times 4%, which I think would give me a cash payment to us of 40,000. So if I extend that, I can get the figure in the balance sheet at the end. And I think the figure in the balance sheet, if I've not made a transposition error, would be 995,958. For those of you, again, that like journals, particularly around the center of this, what's happening in terms of journals, I'll write them underneath. But the working that you use is this working here. If you were asked about the second year, you would bring down 995,958, apply 5.71% and so on. But please don't work out the second year unless you're told to, and you won't be. Once you can do it for 1 year. If you had nothing else to do but you have plenty of things, I think if you ran this debenture for 4 years, you'd probably find the value at the end is the premium 5% on top of the nominal value. But don't start testing out to see if the examiner's got the question right. That premium is completely irrelevant. Journal-wise, though, what's happening here is that initially you have debited, I'm going to put FA for financial asset, and credited cash with the money that you've actually spent, which was 980,000. Secondly, you've got your finance income. That would debit financial asset and credit profit and loss with 55,958. Thirdly, you've got that coupon coming in. So Debit cash, lovely. Credit your financial asset with 40,000. Again, if they ask you to show adjustments, as I keep saying, and you're not sure about debit or credit, just say up and down. So financial asset up, cash down, financial asset and profit up, cash up, financial asset down. So you could use that as explanation as well. But that example hopefully reminds us about amortized cost accounting. Also teaches us or reteaches us that shares always measure at fair value. Gains or losses, P&L or OCI. OCI if you make an irrevocable election. There's quite a lot there, so you may want to listen to this part of the recording again. But that's it for financial assets.